building the structure, this is where we start to get into some of the detail. We are going to get into income statements and balance sheets and understanding the structure of financial reporting. One of the things that I'm going to cover in our conversation about income statements and balance sheets is that there is a perspective that accountants have. There's a way that they report, and then there's a business perspective, which in my opinion is a more user-friendly way of looking at financial statements. And I'm going to show you how to convert from one to the other so that we can use a more user-friendly version and also a version that makes more sense once we start looking at the business in terms of its financial future rather than its historical past, which is what accountants do. That requires us to do some rearranging of the balance sheet in order to understand this business perspective. We'll get to that shortly. So let's dive in here. We are going to start with the income statement, or often referred to by as accountants in its new age name now, is the comprehensive statement of income. So we're going to start off at the top with sales. Sometimes we might use terminology like revenue or turnover, money we receive from customers. We're going to subtract from that some cost of sales. And in this context, cost of sales is going to be the cost to manufacture a product. So for now, we're assuming that this is a product business and not a service business. So loosely, we might say that these cost of sales, manufacturing the product, maybe delivering the product to the customer, they are variable expenses. I'm just planting that seed for later on when we come back to this conversation under management accounting. That's not to say all of these costs are variable, but let's say most of them are. And variable implies that as our sales increase, our cost of sales will increase. So if we move on, sales less cost of sales will provide us with our first profit measure. I'm going to call this gross profit. And it's really just a subtotal as we move our way down the income statement. So next up is we're going to pay some expenses. And in this context, expenses are things like salaries, rent, overhead costs if you want, and maybe we might even go as far as calling these expenses fixed costs. They are the expenses in the business that don't change even though the sales might go up and down during a financial year. Next up is the profit before interest and tax, sometimes referred to as EBIT. So you might have an E in there instead of a P. And I refer to it most commonly as something called the operating profit, profit from operations, if you like. Next up, we are going to subtract some interest expenses. So these are expenses that relate to the debt in the business. If you've got no debt, you've got no interest expense. Then we have the profit before tax, again just a subtotal. Calculate the tax. So in South Africa, the tax rate is 28%. That's the corporate tax rate for companies. Not to be confused with VAT, which is 14%, or PAYE, that might be taxes that are on salaries, which are all under expenses. This is the corporate tax rate. So this is 28% of the profit before tax, which is the line above. We subtract those taxes and we get a profit after tax. Again, another subtotal. Then we pay some dividends, maybe, depending on whether the business has a policy to pay dividends. It's up to management's discretion. And then we have something called the retained earnings. In other words, the money that's kept in the business. So what you'll notice in my income statement is I've used all this kind of short language terminology, which if you see on its own probably doesn't mean much. But I've given you some descriptions of what those are all about. I haven't shown any minus signs or anything like that because accountants don't show that information. As we work our way down the income statement, we are effectively deducting a series of expenses as we move down. And this is a very common structure that accountants might use. Typically these days, accountants don't include the dividends and the retained earnings components in the income statement. They have somewhere else where they put that. But I put it on the bottom here because it actually makes sense to see it in the context of the income statement. Right, let's move on to the balance sheet. So I've used a balance beam here in order to show you what this looks like. And I'm going to put in here on the left-hand side a series of things that are referred to as liabilities, and E stands for equity, and D stands for debt, and CL stands for current liabilities. And together these make up liabilities, which is money that we owe to someone. So of course the equity you owe to the shareholders, this long-term debt you're likely to owe to banks, and the current liabilities most likely is money that we owe our suppliers. There's also some more stuff in there, but we'll come to that shortly. On the other side of the balance sheet, we have something that's referred to as the fixed assets. Those are our long-term assets, if you want. And we have some current assets, which are short-term assets. In other words, they are assets that only stay in the business for a short period of time. Now, you cannot buy any assets without first having some equity or some debt, some money, in order to buy these assets. All right, so the accountants suggest to us that we acquire these liabilities from someone and we use this money in order to buy these fixed and current assets. Let's put some descriptions in here. All right, so there's a formula. The assets, these assets here must be equal to the owner's equity and the liabilities. So that's the formula that accountants work on. Here are the assets, here's the owner's equity and the liabilities. Because it's an equal sign, you can write it either way around. So here we have some fixed assets and some current assets. Here they are. And these are equal to the owner's equity. Up here I called it E, plus the long-term liabilities. I'm just simply calling that debt, and plus the current liabilities. So this equation is in balance, if you like. So if we just look at the balance sheet and we put some terminology in here, we can see that this equity is money that shareholders invest in the business. You might call those partners, you might call them investors, and typically this is represented as share capital. Some debt in the business, accountants call these non-current liabilities. There's this kind of fancy terminology. I simply call it debt, money that we owe to the bank. We normally have to pay this off over a period that's longer than 12 months. That's what makes it long term. And here we have some current liabilities, which is short term, mostly accounts payable or money we owe our suppliers, and creditors is another name for that. We might find that we have some overdraft and VAT taxes and other taxes outstanding that might be part of those current liabilities. Moving across to the other side, fixed assets are referred to as accountants often as non-current assets, and this includes property, plant, equipment. There's some other things in here typically that are things like vehicles, computers, furniture, fittings, etc. All those kind of permanent fixtures in the business. Now when I use the word permanent fixtures, I mean they are permanent in that they stay in the business for longer than a year. It doesn't mean that they are fixed to the ground. Vehicles can be fixed assets. Current assets are our short-term assets, debtors, accounts receivable, etc. Inventory, stock on the shelf if you like, and obviously cash in the bank. Alright, so there we have this accounting perspective, this is how accountants report. And I know that you need to see some numbers with this probably, and we will get to that shortly. So I'm going to end this video here. This is the first half of it if you want, just to break these up. And we will then step forward into changing from an accounting perspective into a business perspective and see how that helps us structure our thinking around these reporting statements and helps us find some clarity in it. See you in the next video.